Thanks for joining us today on Market Call. I'm Marella Fernandez. Barry Schwartz on the show with us, President, CIO, Baskin Wealth Management. He'll take your questions on North American large caps. Here's how to reach us. 1-855-326-6266 if you want to dial in. If you prefer to email, you can do that as well. marketcall@bnnbloomberg.ca. Very good to see you. Thanks for coming in.
Thanks for having me.
We had some of the big tech companies report over the past few days. I'm wondering, first of all, what is your reaction to the results? And what do you make of investors' reaction to the results?
It was quite a busy. I think they all reported on Wednesday or the big ones.
And then Apple yesterday.
Yeah. So we own, our clients and myself own Microsoft, Amazon, Google, Meta, and Apple. So I think aside from
NVIDIA, yes.
No, we don't own NVIDIA. Sorry, yeah, but I mean, unbelievable, huge move. Obviously, Google, Amazon seem to have recovered. I mean, the results from all of them were fantastic, in my opinion, and accelerating revenue growth. They are starting to show inroads, making money on AI, their AI investments. What continues to put pressure on some of the names, of course, is just the continued huge spending on CapEx. It doesn't look like spending is going to come down in 2027. But isn't that what you want as an investor? Don't you want your companies to reinvest the cash flows if they're going to deliver high rates of return? Meta is the one that's the most...
I was going to ask you, are you putting Meta in the same basket or no?
I just bought a lot more yesterday for our clients. We added more to our position. It's trading at an extremely reasonable valuation, in our opinion, around 16 or 17 times earnings. Revenues are growing at 30%. You know, it's very hard to find a $1 trillion company growing at 30+%. NVIDIA does, maybe Broadcom, maybe Meta. And the market completely ignores it. You got, unlike some other companies, you still have the founder, Mark Zuckerberg, sticking around there. He doesn't need to continue to work anymore, but he's working hard. He has a vision. The problem with Meta is their vision isn't properly articulated. It's kind of vague. They want to create some kind of super intelligent AI god.
Is that a lack of wanting to share the information or not having a clear vision on their own?
I think it's a lack of wanting to share the information based upon what they're working at. They're clearly behind on these learning language models. Google is the reason why Google pops so much is because it's the clear winner. It has now eclipsed ChatGPT in terms of its ability to advertise on AI, its ability to integrate everything. The stock, as you see, just keeps going up. And to be honest with you, Marella, I don't know if there's a bottom for the stock anytime soon because the business is running so good. There's such great integrators. They've turned it around. If you think AI is going to be a winner, Google is going to be in our opinion, the complete dominant winner.
So you're beginning to see that separation now where everybody was putting into AI, and we have always said there'll be winners and losers. Are you seeing that shake out a bit now?
Well, I can't speak to that, but what I would say is everybody's using their models, Amazon's models, Microsoft's model, and they're not switching off. But the new models, the new startups are all using Google. Google has the best models, so it's really now the big winner. But I think all of them are winners. All these hyperscalers are winners, clearly, if you look at their results. And just on a valuation basis, Meta looks the most attractive to us. And, you know, I think Zuckerberg is really good at listening to the street. He says he's going to continue to invest. He might, unfortunately, do a bunch of layoffs. But at some point in time, I think that the street will come around to what they're doing and reward the stock because the top line growth is incredible.
Let's take a quick break, then we'll line up the first phone calls and emails for Barry Schwartz, Baskin Wealth Management, taking your questions on North American large caps. Here's how to reach us. Back in just a moment. Welcome back to Market Call. Let's go to an email to start. The question is about an outlook for Couche-Tard. Should I buy or should I hold? And that's coming from Greg today. I haven't looked at Couche-Tard in a while. We'll pull that chart up in just a moment and take a look at it. What do you think about Couche-Tard and growth possibilities for the company?
Well, we like it very much. I own it. Our clients own it. We started buying it, Morella, I think in 2024. Right after that, they announced they were looking to buy 7-Eleven. The stock got crushed. It fell to the mid-60s. I bought more. I remember at the time people saying that deal would be terrible, and that it shows the company's not growing anymore. The company obviously abandoned that deal. They've restarted the buyback. There's still lots of white space for them to acquire, and the results are starting to improve. That's why the stock has picked up recently. Over the last number of years or so, after the pandemic kind of boom, which was great for convenience stores and gas stations, that kind of cooled off and returned to normalized results. Couche-Tard kind of suffered a little bit. It doesn't have as good food offerings as some of its U.S. competitors. It's fixing those problems. You're seeing it in the results. The stock, it's not exceptionally cheap here, but we see it as a great long-term investment. The company's buying back a lot of stock, lots of opportunities for M&A. If the growth is there, 3 to 5% a year, you can see a nice tailwind for double-digit growth in earnings for a very long period of time.
So you're happy holding it?
Oh, yeah.
Okay. Let's get to our first caller then. Henry is on the line. He's in Vaughan, Ontario. Henry, go ahead.
Good morning to you. I'm looking at the Barrick Mining. If it drops down to 50, I think I would buy it. It's got trust support at that level. What's your opinion? Thank you.
Thanks for the question. Barrick Mining at 52 today. Can I get your outlook on gold as well?
So I don't know if anybody can give you an outlook for gold, right? I don't want to poo-poo gold or say anything too negative, but, the prices run up on gold. You would have thought start of an Iran war, a month later,
it would go up more.
Be up more. It isn't. So I don't know what the bull case or the bear case is on gold going forward. Obviously, we don't own any gold companies. I don't like miners as a investment for our portfolio. I don't think mining is a good enough business that delivers high enough returns on invested capital. But obviously, Barrick and Agnico Eagle are the two top gold companies in Canada. I would probably, if I was going to buy a gold stock, probably lean more toward an Agnico Eagle. But the only reason to buy them is if you have a firm belief that gold prices are going a lot higher, and it's impossible to know. Meanwhile, people are still paying $78,000 for a Bitcoin, so maybe it makes sense for gold to be at $5,000. I don't know.
So you're not in gold at all?
Not at all.
All right. Let's get to the next caller then. Andy is in Calgary. Go ahead, Andy. Andy, are you there? Okay, we may have lost Andy. Let's see if we can get to Chris in Delta, BC. Chris, go ahead.
Oh, good morning, Morella. Chris is here. Barry, I would just like to say, I listened to the podcast, which I highly recommend that everyone check into. The Baskin Wealth Investing Podcast, not an advertisement. The positivity, the sky is always falling, and Barry just has a good way of parsing through that noise. And I'd like to ask on Restaurant Brands International, it's had a great recovery, actually, and buying the dips has paid off, good dividend yield. And I'm just wondering, Barry, if you still like it today. Thank you so much.
Thank you for the question. Restaurant Brands.
Thank you for the compliment. I guess I owe Chris a Timmy's.
Apparently, you're quite sunny and optimistic on your podcast.
You have to be optimistic as a long-term investor. There's no other way to exist. If the sky is always falling, and I've been doing this for 25 years, and every year there's been a problem and uncertainty, and it's never been easy. And every stock that we've owned for years and years, some point at some time, someone's told me to get rid of it because they didn't like it. So I focus on what I focus on, and that's long-term investing. Restaurant Brands fits the bill for us. The reason why we own the stock is Patrick Doyle, who is the chairman. He turned around Domino's Pizza, made it one of the best performing stocks on the U.S. market under his tenure by really focusing on improving operational results. They're still working on Burger King. Tim Hortons, nothing to fix there. Such an incredible business. I think that Tim Hortons business is so undervalued within the Restaurant Brands complex. It should trade at a Starbucks type multiple, given how fantastic that business operates. The Burger King, the Popeyes, not so good right now, but things are turning around. We'll see the results out. The problem is there's always headwinds. Beef prices have gone up. Food prices have gone up. Cost of delivery has gone up. So it's going to impact the results, but you're not paying a high multiple for a very, very well-run company.
And they do have a bit of a dividend, 3% or so.
It's a royalty business. It's all free cash flow. The problem is in the last couple of years, they've had to reinvest in the Burger King franchises, fix them up.
Yes.
You got to make them look prettier. That's over, we think, by the end of this year, and the free cash flow is going to start to gush. I wouldn't even be surprised if they're looking at one of the pizza companies to make an acquisition, either Pizza Hut or Papa John's as well.
All right, let's get to the next phone caller. Craig's on the line. He's in Toronto. Craig, go ahead.
Good afternoon. Thanks for taking my call. Barry, I wanted to ask you, I think a couple of years back you might have recommended Vail. At the time, I had bought it and I made some money on it and I sold it. And since that time, they seem to have fallen on tougher times. The stock's down tremendously to 52-week lows. And I'm wondering, first of all, do they have very high debt? And is there good value in this stock? And secondly, they're paying out quite a high dividend. Is that likely to get cut? And will that be beneficial to the stock? I'll hang up and listen to your replies. Thanks for taking my call.
So they're a holding company. Can you tell me a bit more about them?
Vail Resorts, it owns a number of ski resorts across North America and Europe. Obviously, the most famous one that Canadians will know is Whistler Blackcomb, right? So Vail, we did own the stock. We used to own shares of Whistler. It was a standalone publicly traded company in Canada. Vail acquired it. We made a bunch of money on it. We kept the Vail stock. It worked for a bit, and we got rid of the stock in around 2024 in the 200-plus level. I probably should have been more aggressive getting rid of it earlier. The reason why we sold the stock is weather. It's clear to us that something has changed. There's been 3 years in a row where it's not snowing, and it's not working for Vail. And yes, the balance sheet doesn't look good. They raised the dividend. You can obviously it's reflected in the stock price. The stock has been absolutely crushed. I think this will be taken out by private equity or someone because the assets are still for perpetuity, right? Maybe we'll start snowing again properly in the next 2 to 3 years. People still love skiing. They own some terrific assets, but it's not one that we're interested in now. If I can't see double-digit predictable earnings growth of 10% or more, I'm not interested, and it's very hard with Vail to figure that out.
We'll take a quick break. We will be back with Barry to answer more of your questions in just a moment. Stay tuned. Welcome back. Let's go to an email from Lenny. He says, can I please get Barry's thoughts on Lyft? Lyft seems to have been very much overshadowed by Uber. Are they able to fight their way back? Are they doing anything innovative to gain some market share?
Well, I mean, like Uber's like the Kleenex of the world, and Lyft is like, you know, the
no-name brand
paper
version,
tissue, right?
yes.
It's a no-name brand. It may offer better service or cheaper rides. I don't know. I haven't used it. For me, it's just Uber Eats. That's what I'm used to. And so the network effect, once you use a service, it's very hard to switch off. Lyft, obviously, it needs scale. It needs something, it needs to spend a bunch of money to capture the market share from Uber. And I think it's too late. Meanwhile, DoorDash, as you know, as food delivery is killing it there. So I wouldn't want to go against Uber. It's not an invest. Like, look at the stocks now, 75%, purely speculative. I don't even know if it makes money. So something could happen. It could be bought by one of the big techs, and they may want to integrate their technology into some kind of self-driving car thing. But that's really your only hope here with the stock. So I would stay away. It's not something I would ever buy for clients.
Let's move on to Anno calling from Markham, Ontario. Anno, go ahead.
Hi. Actually, this is Anuj.
I'm sorry. That they gave me the wrong
all good.
pronunciation. Anuj, what is your question today?
That's fine. Hi, Barry. Just a quick thoughts on Topicus. I've seen your podcast on in the YouTube, and you have talked very highly about Topicus. And as you know, Topicus and Constellation Software, they have all gone down. Are you still bullish on Topicus? Thank you.
Thank you for the question. What do you think about Topicus?
Yeah. So here's the interesting thing. We haven't seen any impact whatsoever from AI on software demand. None whatsoever. You're looking last night, I think, at Atlassian, it's ticker symbol Team reported. The CEO was on another show. He said, we're not seeing any impact. In fact, we're seeing growing demand for our software. I'm a business owner. We pay for software. There's no way I'm going to switch to AI. All my data is consolidated at a book of record. How do I access it on some vibe-coded software? It's just not happening. Topicus is a fantastic business in our opinion. The company's growing way faster than Constellation Software. You are paying a little higher multiple for it, but not right now. The stock was $190, I think, last year. It's now half price, but there's been no change in fundamentals. In fact, it's probably going to improve because we think these companies are pivoting very quickly to AI. They're going to start integrating these language models into their software. Yes, they'll have to pay money for the tokens to use it, but I think they'll pass on those expenses to the business customers who will happily pay for it if it works better and reduces costs. So we're very, very bullish on many, many software companies here.
What kind of software do they provide? Is it integral to Office?
Yeah, so it's a niche. Topicus and Constellation are niche software providers, so they own payment systems, HR systems, that kind of stuff for small businesses. So it's not like an enterprise like a Microsoft or Adobe that has millions and millions of customers. It's targeted to specific industries. And what sets Topicus apart is it mainly focuses on Europe.
And you think they'll get back to that when people sort of look at the bottom line and realize that the fear is over?
Stocks are going to do what stocks are going to do, but if the fundamentals are improving and they're up to the right, I'm going to continue to hold the stock, and I see lots of value in this for the long term.
Let's move on then to Jack. Jack is in Oakville, Ontario. Jack, go ahead.
Good afternoon. Thank you for taking my call. Barry, I'm looking at McDonald's, and there seems to be a real weakness in the stock coinciding with the war in Iran. Is it because the concerns with customer spending, consumer spending, or there are any other reasons for the weakness? And do you own the stock or would you buy it at this point? Thank you very much.
Thank you for the question. Okay, so we're looking at the chart. End of February is when the conflict started, and you see sort of that trailing down from March. But is there a connection you see that's obvious? Transport,
not really.
Maybe cost of gas?
It could be factor related, right? McDonald's is seen more as a consumer staple, that kind of company. And when the market is ripping like it did in April, like some of these NASDAQ stocks are up 20+% in 1 month. Like, you can make 20% in 1 month, or you can own McDonald's, right? And so for the momentum traders, there's no fun owning McDonald's. You're never going to wake up and find McDonald's is going to be up 20% after earnings. It's just not going to happen. But very consistent company, terrific brand, hundreds and hundreds of millions of customers. We just prefer Burger King because our restaurant brand's trading at a cheaper multiple and growing faster. And I prefer Domino's Pizza because I don't understand the disconnect with the valuation. Domino's is growing, taking market share where its other pizza competitors aren't. But neither of those stocks have really, nothing really has worked in the fast food at the moment. The Wingstop was down big time last week. Chipotle's sales are meh. So, I think the consumer in Canada and U.S. is obviously wrestling with higher food prices, higher inflation, and visiting these restaurants a lot less.
Staying home a little bit more. Okay. Let's get to Matt then. Matt is in Saskatoon. Matt, go ahead.
Hi there. Thanks for taking my call, Barry. Always great to have you on the show. I'm wondering about Copart. I'm wondering if you could specifically talk about the valuation. It's really taken a hit as of late, but now it's trading at 19 times earning and has $5 billion on the cash sheet. I'm wondering if you'd look at buying more.
Thank you for the question. How closely do you follow Copart?
We owned it as of yesterday, and we no longer own it.
Okay, so
we just sold finished off selling our shares today in Copart, not because we think it's a bad business, not because we think the company isn't going to have growth going forward, but it's facing a lot of challenges. This company's in the auto auction, junking business. It's it's not really losing market share, but it doesn't have exposure to the fastest growing insurer, which is Progressive in the United States. RBA, which is a Canadian-based company, which owns a competitor of Copart, is doing a lot better. The other issue, of course, is in the U.S., a lot of people are driving without insurance. If they can't even afford to go to McDonald's, How can you afford car insurance? So that's a real headwind. The other issue that worries us, of course, is long-term is autonomous vehicles and getting into fewer accidents. On the plus side, as the caller said, valuations at the lowest in a long time. Beautiful balance sheet, $5 billion net in cash, and you still have the owners, the founders still owning a significant stake in the business. I'll look at it again, but I swapped it for a couple names that we think are just growing a lot faster, where the market is just hating on. One of them is Meta. One of them is my top pick.
That's coming up.
That's
okay.
coming up.
Let's take a quick break. We'll come back with past picks from Barry Schwartz in just a moment. Welcome back. Time to go through past picks from Barry Schwartz from June 3rd of last year. At the time, he chose Apple on the NASDAQ, which just reported yesterday, and clearly he's doing well. 203.27 US at the time last June to 271.35 today. 33% upside, 34% total return. Are the lingering concerns about Apple not having its sort of own AI entity and build out a problem for you?
I don't know if that's a concern. It may be viewed as a real positive, right? Apple's capex for the quarter was $4.3 billion. The other
Compared
guys,
to the $200 billion.
Yeah. So
sure.
it's like nothing. And Apple is the king. It is the GOAT of companies. You can't access AI or the internet without essentially Apple, right? And just the demand for its products continue to be very, very strong. The reason why the stock is up tremendously today is the guidance for Q2 or whatever the next quarter is was double-digit top-line growth. Market was totally not expecting that. I remember a few years ago, people were saying Apple's no growth, and now here it is growing again at double digits.
Their MacBook's doing really well.
Yeah, and taking market share from the Google Chromebook type things. So what I would say is I've owned this stock myself and for clients since about 2013. We trim it on the way up because we never want one stock to get too big in our portfolio. But I love owning companies that have billions of customers who can't live without their products. And this is one of the best ideas that I can come up with. Is the valuation isn't that cheap here, but you're paying up for a premium business.
Roughly, what do you keep it at? You mentioned you trim as you go up. Where do you like it at?
We like to keep stocks around 6 or 7% allocation at the high level, for rightly or wrongly. But I'm not a hedge fund. There's no performance fees at Baskin. I'm managing people's entirety of their wealth, investable assets. I'm trying to protect their capital. I'm not trying to, have 25% in one stock and look like, and then have big risk if it goes down. So not our style, not our approach.
Let's get to your next past pick from June of last year. Berkshire Hathaway, 497.83 US at the time to 473.60, so 5% down, 5% total return down. Let me ask you why you think Berkshire Hathaway has not bounced back since the retirement of Mr. Buffett. Everybody thought, okay, this is initial jitters because he's no longer sort of leading the company and it'll bounce back, but it hasn't. What's going on here?
Well, I can't tell you what the market is thinking. I could say that the results haven't been up to stellar that others may have expected over the last year or so. The insurance business hasn't been tremendous. The railroad, okay. Some of the other parts of the business, not great. But I'm excited to see how the business does under Greg Abel. All I care about is what's going to happen going forward. He seems to be a terrific operator. He seems to be very confident on Berkshire stock, announcing the buybacks again, as well as says he's going to use his salary every year to buy shares of Berkshire. The valuation is quite attractive here. I think this is a company that will deliver double-digit returns for investors over a long period of time. It's not sexy. There's no AI fun stuff in it, but what you're doing is you're betting on the growth of the United States, and I think that's a pretty safe bet to make. Greg Abel's got good hands and mentored, obviously, well by Warren Buffett, who's still coming to work every day, by the way.
Let's get to your next past pick then. Constellation Software, CSU on the TSX, at 4,945 last June to 24.73 right now. So 50% downside, total return the same. suffering from the same software anxieties, I guess investors have.
Good thing I didn't eat lunch before.
And also a new leader, right?
Yeah.
So I know you like some of the software stocks and you think there's a bounce back because people are hammering them too much. Do you see that same concept in Constellation Software?
That's right. It's a narrative right now. There's no evidence in the fundamentals. Obviously, if you talk to anybody in Silicon Valley, they're going to say, yeah, we're all working on stuff to replace software with AI, and we're all getting backed. We'll have to see how that plays out. But what gives us comfort with Constellation Software is it has over 1,000 different business units. And not all of them are going to be displaced by AI. Some of them will actually benefit from AI. Some of them will be big winners. In the meantime, it's not like Constellation Software was buying companies at high multiples. They tend to pay very low prices and earn their money back in a very short period of time. I don't think the market clearly understands it. Constellation is the cheapest investment in our portfolio right now. If I could, I would make it a 20% position. I'm not going to but I'm
Have you been picking up more on the slide down?
We sold shares of Adobe, which we had less confidence in, to buy more Constellation Software, and we continue to add it. But we like to diversify. I can't take a one-way bet on anything. But Mark Leonard, I'm sad that he's no longer running the ship, but he's got terrific people running the operations. Everything that could go wrong did go wrong last year for Constellation Software, but nothing's going wrong with the fundamentals.
Let's take a quick break. We will come back with more of your phone calls and your emails for Barry Schwartz in just a moment. Stay tuned. Welcome back. Let's go to Scott on the line in Markham, Ontario, with his question today. Scott, go ahead.
Yes, thank you, Barry. I heard your comment on Adobe. I own it. I'm down 40%. Would you think I should switch to something like Microsoft or Constellation? Thank you.
Thank you for the question.
I can only tell you what we did and give you our rationale. By the way, I still own it personally because I haven't got around to selling it in my portfolio. I'm not allowed to make trades every single day like I can for my clients. We have regulatory requirements as a wealth manager, but at some point I will probably exit the stock. But the reason why we sold it, there's a number of reasons. First of all our clients unfortunately had a capital loss on it. And I don't have too many capital losses in my portfolio. So we've been taking gains this year on a number of our stocks, doing a little bit of rebalancing. And so we need some fodder to replace it. We still like the software space. So we swapped it for Constellation Software, get the capital loss, get what we think is hopefully a company that we think is much better than Adobe. Although I think you're going to do fine owning Adobe here. If you ask Adobe's management, they'll tell you we're seeing no signs of AI.
A fall off.
No, okay. None whatsoever. But it's not growing at the same rates it used to. This was a 20% grower, now it's a 10% grower. Beautiful balance sheet. I'm not smart enough to figure out whether AI is going to kill its business. I would probably say that it's going to enhance its business. But the valuation is pretty attractive here, and so I'm really excited about software. I'd rather consolidate in my best idea, which is Constellation.
Because he's watched it slide down the way he has and lost sort of 40%, would you perhaps sell half the position and put it elsewhere as a compromise?
It all depends on what your view is going forward. If you think it can deliver decent returns, there's no reason to sell it. In fact, you probably should buy more. When companies are growing, it's never the right idea to sell them. Just because you're down on it. But if you want to take a capital loss and it makes sense, maybe that's the right approach.
Let's move on to Doug then. Doug is in Salmon Arm, BC. Doug, go ahead.
Hi there, Barry. Two short questions. Did your partner retire, Mr. Baskin? And when do you take profits? I've got many stocks that are up 200 and 250%, banks and pipelines and whatever. They say let your winners run, but when is the time to say, I'm going to let the house play with my money? Thank you.
Thank you for the question. Yeah. And that's an interesting question because people do want to know when's a good time to either trim or exit a position?
I'll speak to my partner, David Baskin. Yes, he's still a shareholder at Baskin. He's stepped down from the operating part of the business, but still coming in to work almost every single day. And, a terrific investor long term. And obviously, we're retaining the name as a result. So what I would say about taking profits, I manage people's money, right? And I treat it as if I'm investing every single dollar that they have, whether I do or not. I'm not a hedge fund. I'm not a mutual fund. I'm focusing on capital preservation. So for us, we use strict rules in the sense of if something gets too big in a portfolio, we trim it back. Whether that's the right decision or the wrong decision, that's one way that we rebalance. The other thing is if the stock valuation gets too high, even though we like the fundamentals, we might trim a bit and rebalance into something more attractive. Asset allocation is important to us too. If we do really well and the stocks go up, we trim stocks to buy fixed income. So that's how we think about stocks. Selling, of course, it isn't because the stock's going up or down. It's because we found a better investment idea, or we find, or clearly we've made a mistake with the investment and it's not growing anymore. I've never been upset selling a stock where the fundamentals have stopped growing or even turned negative. I don't want to be around. If I can see double-digit earnings growth, then I want to be interested in that stock. So
lots of good advice packed in.
I hope so.
He has to consider his own situation and what works for him. Let's go to Vahid in Victoria, BC. Vahid, go ahead.
Yeah, I appreciate Barry's opinion on Nike. I paid $95 2 years ago per share. Now it's $44. Should I average it out, hold, or sell?
Okay, thank you for the question. Nike is in the midst of trying to turn things around, of course. Do you have faith in the turnaround?
I still think it's trading at an expensive multiple, but here's the thing. I'm a little bit rules-based, and I don't like to buy fashion or clothing companies. Years ago, like Nike was the it stock.
So
now
too risky?
It's just fashions change. And what was hot for your parents, the kids don't like it anymore, right? And so you can look at Lululemon, for example. All my clients were asking me why I didn't own that when it was going up. No one's telling me now to buy it. Same with Canada Goose. Now, of course, the darling stock in Canada is Aritzia. You don't ask me about women's clothing. I know nothing about it. I don't even like shopping. So I stay away from clothing. I don't understand it. I think tastes change way too quickly. And so, I've seen it by experience. So it may be a great investment, but I'm not going to ever own it for clients.
Let's take another quick break then. Barry Schwartz of Baskin Wealth Management taking your questions. North American large caps. We're back in just a moment. Stay tuned. Welcome back. Janet's been holding on the line in Waterford, Ontario with a question. Janet, go ahead.
Hi, I'd like to hear your views on Enghouse, ENGH.
Okay, thank you. Is it Enghouse or Enghouse? How do they pronounce it?
I don't know.
Okay, do you like it?
No, I don't. But clearly the stock hasn't performed well. It's like a mini Constellation type business where it acquires software companies. Obviously, their execution hasn't been really good lately. This is one where the fundamentals have gone the wrong way. The company did have a little boost during the pandemic as it owned like a video conferencing business that was
prime time
growing.
for that.
Yeah,
yes.
And then nothing has really clicked. It may be trading really at a bargain level valuation now. I'm sure it has a pretty decent balance sheet. But I tend to stay away from smaller cap companies for our portfolio. It's just too hard for us to own companies where the market cap is smaller, and if we have to exit, it's a problem. So I always want liquidity. I always want to own the best and breed, the best company in the industry. So that's why I'm sticking with Constellation.
Why
software.
is it smaller to exit if it's a smaller cap company?
Well, if you have a large position in it and you want to trade out of it,
you can't find buyers.
You can't find buyers, or you can find buyers obviously at a certain price, but it's harder. Whereas at Apple, you can blow it all out in 1 second.
Got it. Yeah. Okay, let's get to Murray on the line in Calgary. Murray, go ahead.
Hey, Barry, great to see you on BNN. You've seen that you already answered my Constellation question. I've gone to my Plan B stock, and that's Dollarama. The market didn't seem to be too thrilled with their past earnings, but is that just a short-term blip and a long-term growth story? And I'll just hang up and let you do the rest. Thank you again.
Thank you for that question. Dollarama, I would imagine, would be doing well considering the price of fuel and people have less money in their pockets. But
Yeah.
stock's down.
Well, you're paying a high multiple for growth here, and the growth didn't deliver as people are expecting. And no question, I don't know what. Do they sell anything now for $1? It's probably the price points are going to be $10 plus.
Yes.
I don't know if that's going to be the case. I mean, there's also just the fact that the Canadian consumer is feeling a little bit pinched as well. But the growth, a lot has to go right for Dollarama to justify a high multiple. Clearly, the market is saturated in Canada for them, so they've gone and made acquisitions in Australia. They've gone and tried to make joint ventures and acquisitions in Latin America. When those things start to happen, it makes me very, very nervous when you're going outside your core country where you don't know anything about those other countries. And so, unless it was trading at like 15 or 20 times earnings, I'm not interested in the company.
That was for Murray. Let's go to Faisal in Toronto. Faisal, go ahead.
Hi, good afternoon, guys. Thank you for taking my call. Barry, picking up on the software is not dead theme. And I do agree with you. I don't see industries like the oil industry or the bank industries swapping their software needs and using AI to replicate it. That being said, can I get your thoughts on CGI? It is really sold off, and is it a good time to get in? Thank you.
Can you remind me a little bit about, I know they reported this past week, but about the kind of software that they run?
Well, it's a consulting company like Accenture.
That's right, yes.
And so it helps Fortune 500 companies and Bay Street companies implement new technological innovations. The problem is, I think it's more structural right now or cyclical right now. We're all now moving on to this AI. We're trying to figure out how to implement it. There's really no killer app yet for a lot of companies. When that happens, I think they will turn back to the CGIs and the Accentures of the world. So I think it's just a lull in the business. I mean, the results of the company are fine. The balance sheet is very, very nice. Great capital allocation. You're always going to need consultants. I'm never going to be able. I don't even know how to use Excel. I barely know how to use Excel.
Ask you, is this the kind of company where, because there's so much AI, a company could go and say, I don't know what to use and I don't know how it's going to benefit me. You figure that out. And
That's me as a customer, exactly, right? And so I think it might take a little bit, but it's probably an attractive opportunity to look at some of these consulting businesses right now. They've been hate sold, right? CGI is like an absolutely crushed. But right now, they're just not getting enough contracts to have justified a premium multiple. It's fallen now to a reasonable multiple, and it has to get back to growth. I think they're great acquirers, and if the AI implementation picks up, this could be a good entry point.
All right, Faisal, I hope that's good for you. Let's get to an email from Gary. Can I get your thoughts on General Mills? I haven't talked about General Mills in a very long time. What do you think?
Yeah, I'm trying to think of what their main cereal is.
I don't know anymore.
Yeah.
Let me look it up.
I don't eat cereal anymore.
Lots of people don't eat cereal
I used to eat cereal all the time. Now I just have coffee. My kids don't eat cereal. It's just what's happening is tastes are changing. We're all very much now focused on protein and people having smoothies and people, a lot of people on these GLP drugs. So.
Check cereal Cheerios and Cinnamon Toast Crunch.
Oh my God, I grew up on Cheerios.
Lucky Charms.
Ugh. I grew up on Cheerios. I would eat it every single.
Pillsbury.
If my mom made liver and onions and I wouldn't eat that, I would have Cheerios for dinner and get yelled at.
You had a choice. Okay.
Yeah. So listen, these companies are very, very hard. The only consumer staple business we're attracted to is really Costco and Coca-Cola. We own both. Those companies are still growing. I would recommend Coca-Cola over General Mills. The growth of Coke continues to be explosive for the zero drinks, and they're just smart operators, and they own very capital light. So I'd rather own a business like that than fool around with a company that's losing market share and deteriorating fundamentals.
We're going to take a quick break. We'll come back with Barry's new top pick. Stay tuned for that. Join us Monday for Market Call. Bryden Teich will be on the show, Chief Investment Officer of Avenue Investment Management. He'll take your questions on North American equities. That is on Monday. Let's get to new top picks from Barry Schwartz, starting with Fairfax, FFH on the TSE. Tell me what you like about Fairfax. I haven't looked at their line in a while.
Yeah. Well, today's a pretty good entry point for the stock. All my top picks today are companies that have no momentum, no key catalysts, just excellent, well-run businesses where we think they're going to add long-term value. I don't know if they'll look good in a year from now, but I'm quite certain they'll do very well 3 to 5 years from now. So Fairfax reported earnings last night. Fairfax, as you know, is a North American European insurance, focusing more on commercial insurance, run by Prem Watsa, who's done an amazing job compounding capital at 19% a year since the IPO. It hasn't been an easy ride for Fairfax. What got us interested in the company is that over the last number of years, the insurance business has really improved. To make money in insurance, you have to be good at underwriting and you have to be good at investing the money. Over the last 10 years, they've been excellent underwriters and clearly great investors. Their compound rate of return on their investment portfolio is 7.7% a year. Doesn't sound so amazing, but keep in mind half of that was in bonds and cash. So those are very good results. Fairfax doesn't invest the way I invest. I like to buy growth, high-quality companies. They like to go bargain basement hunting. Fine, that's a different hedge for our clients. But the bottom line is I think Fairfax will deliver at least 10% compound rate of return over the long term. This is not a company that, you buy it for one quarter and trade on momentum. You buy it for the long term, hoping that the new generation running the business will continue the strong underwriting and be incentivized to deliver strong results. What I love about it is everybody who works there owns shares. That's,
a good sign.
What better incentive can you have?
All right,
Yeah.
Let's get to your next new pick on the market for New York is Fair Isaac, FICO.
FICO, yeah.
Tell me what you like about this business. It has also been beaten down a bit.
Oh
here.
my, has it ever? And FICO is in the credit scoring business. This is what I like to buy. I like to buy companies that have been beaten up on narrative issues, even though the fundamentals are incredible. FICO just reported earnings. Top line was up 39%. I have no company in my portfolio growing 39%. The company has been beaten up because there are worries of regulatory changes in the credit scoring business, particularly the securitization market. FICO is essentially a monopoly. There's a competing product. No one uses it, even though it's cheaper. It's been offered for free and still no one uses it. The government rightly is trying to push another competitor into the space. FICO says no one's going to use it. The stock used to trade at 100 times earnings, rightly so, because it's a monopoly with incredible return on invested capital. The stock is now trading at 24 times earnings, 23 times earnings. That, for a business of this high quality, it's expensive, but based on the quality of business, really, really cheap. Management owns a big chunk of the company. And if interest rates start to go down, we might see a bigger pickup in loan volume, which is great for credit scoring.
How long have you held it? Did you pick it up more recently?
We just started buying it. We bought it, unfortunately, on the way down at around $1,400 a share. So I look pretty stupid there, but about a bunch more the other day. And so that's what if I'm a loser, I'm happy because I'm like to average down on my losses because I'm going to hold this for a long period of time. And so if it works out, we're going to make a lot of money.
Let's get to your next pick, which is TransDigm. Tell me a little bit about this business.
Aftermarket aerospace parts provides seat belts and ball bearings and everything that an airplane needs. If a seatbelt breaks, the plane can't take off. They have to fix it immediately. TransDigm provides these parts. I have no idea why the stock is down so much recently. They just pre-released earnings, which they said they're going to be better than the street expected. But, sometimes just certain sectors rotate. There's worries maybe that Boeing isn't making planes fast enough. Maybe everybody's buying newer planes right now, so there's going to be fewer requirements for replacement parts. But, more people are traveling. People are getting richer. I'm very excited to own TransDigm here, and it's a reasonable valuation for a high-growth company.
Do they do just replacement, or they do initial supply as well? And what's competition
They do initial supply, and just initial supply is not where they make their money. It's the replacement parts. They also sell stuff to the U.S. for defense.
And competition-wise?
There isn't any competition. They're for the parts that they make, they're a monopoly. You and I can't just sell an aerospace part to Air Canada.
Yes.
You have to be approved.
Okay, and you said there's no reason or obvious reason why it's down.
There's no catalyst right now in the stock. It's not AI. It's not gold. I don't know, but it's a great value, well-run, high free cash flow business.
All right, let's leave it there. Barry Schwartz, good to see you. Thanks for coming in.
Thanks for having me.
And thanks you for joining us today on Market Call. We'll see you back here on Monday.